that is being driven because of the demand for the actual metal. And we've seen Deutsche Bank and Barclays and Scotia Mercado now are shutting down after 300 years. All these bullion banks are vacating the market because the old game of being able to control the market with paper and make guaranteed profits through the containment and the manipulation of the metals prices is gone. So.
Hello, everyone, and welcome into crushthestreet.com. I had a very timely guest on the line today, someone who's been on the show in the past, who's really given us insight, deep insights on what is going on in the physical market: gold, silver, platinum, and palladium, rhodium. Just somebody who really understands what's going on the futures market. And we're going to be talking today about the shifts that we are seeing in the metals market. Gold hit $1,900 this morning as I record this interview. And so silver has blown through its 2016 high of 2179, I think. And we're in a really exciting place right now. And I'm really happy to have David Jensen on the line of safehaven.com. You can follow him on Twitter at Real David Jensen, Jensen. David, thank you so much for coming on the show with us once again.
My pleasure, and good morning, Ken.
Good morning. Well, we were just talking about the disruptions that we are seeing. I mean, with what is going on socially, what's going on politically, the fear of just an absolute breakdown with the system, and then you have what's going on the physical side, and everything seems so extreme at the moment. I'd like to just start off our interview here with just a little bit of an overview on where we are, in your opinion, and just how pivotal this time is.
Yeah, well, I think it is a pivotal time because I think there's been a catastrophe back in March, April, and May, or end of March, April, May, June, when they shut down the economy, and we're living in a debt bubble. And what happens when you disrupt servicing of debt is that you basically take away the foundations of the bubble itself, and it collapses on itself. So I am seeing no recovery coming to us in a way that we've taken away the fervor from the markets, and that everything right now is being, the signals that we're seeing are all being disrupted by central bank printing at an extremely accelerated pace. So I think, Ken, that we're heading into a new economic and a new social world here, driven by the disruption of the economy. After running a debt bubble economy ever since, I'd say 1987, when the LBMA was formed, and Sir Alan Greenspan became chairman of the Fed. So, and I think that the signals that we're seeing are in the physical gold and silver markets are especially pertinent to what is going on in the market overall and the economy overall as well.
Absolutely. And as I said in the intro, we saw $1,900 gold. That is the spot price, but you really track what is going on, what drives the spot price for gold, silver, and all of these different metals. And you're seeing some serious shifts take place. Maybe you could take us through some of that, maybe how we started off the year, how we went into COVID and dealt with the virus, what happened during that time, and kind of what you're seeing now as we see a real ramp up with precious metals interest.
Sure. Yeah. Okay. Just a note of history here that the gold and silver, platinum, and palladium markets in London were dramatically changed in 1987 with the formation of the London Bullion Market Association and the LPPM, the London Platinum and Palladium Market. In 1987, it was driven. Evelyn Rothschild pushed Margaret Thatcher for this, and the Bank of England did as well. And what they did essentially was they converted the London market, where they were trading historically for centuries. They were trading bullion. They converted it into a market where they were trading promissory notes or unallocated spot contracts. So they went from trading metal bars to trading promises to deliver bars. And the reason, one of the reasons that this occurred was that in 1980, gold had run to $850 from roughly $38 in 1971. So over about 9 years, gold had run up to $850, and they had to raise interest rates to 19%, which was in round numbers again about 9% above the prevailing rate of inflation at the time. And the reason they had to raise interest rates so high was they had to attract investors back into government bonds and out of ownership of bullion. So they dealt with that by saying, okay, well, we're going to address the price of bullion by creating our own price of bullion, which is separated from a proper price discovery process. So they formed this LBMA, LPPM. Everybody can read the historical documents and see what they're doing, but they're trading in the gold market. Until quite recently, they were trading about 90% of the trading in London was in the spot market. And it's trading again with these unallocated contracts. But the level of what they were trading was really what was notable. In London, they would trade like 2013, from the best of what I could see, was kind of the peak period around that time, and that they were trading upward of 300 million ounces of gold every day in the London spot physical market. So those are contracts for immediate ownership that they were trading. And they were trading them at a level more than 3.5 times the annual rate of production of gold every day in the market. So, enormous leverage of digitization and what Rick Santelli calls paperization, which is essentially what's happened. Silver was the same thing. They would trade more than 3 billion ounces of silver every day in the London market as well. And that has what has changed so dramatically lately, Ken, and I think we see it in the price action in the markets.
David, let's talk about that. So, and I want to point out for anyone who may have missed it or it went over people's heads, I mean, the volume hit a peak in 2013. So now that's on the downtrend. Why is that significant? Talk to us about what happened this year with delivery issues and what the banks are doing right now and why this is important for what is going on beneath the surface in this sector.
Sure. So just to give people an idea, we're trading right now less than 30 million ounces of gold each day in London. And actually in March, we had a number of instances where the market seized. So they had gone from trading 300 million ounces a day. I talked to a friend at a bullion bank, and he said there was a point in March where the traders were shocked at the company for which he works, that they were looking at the market and there was two contracts on offer. So 200 ounces of gold on offer at one point in the London market. So it had basically failed, and that's what caused people to pile into the COMEX, was that there was no offer in London, and they were trying desperately to get hold of gold and silver, so they jumped into the New York contract. But what we've seen overall here for the New York futures contract, by the way, which is not a spot delivery market there. But what we're seeing now here is this drastic drop in in trading volume in gold and silver. And what that is signaling to us is that the bullion banks are unwilling or incapable of selling into the market the massive volumes of spot contracts that they had done for several decades. And the reason that's important, Ken, is that they were essentially controlling the price. One of the central tools that they use to set the price of gold and silver and to disrupt proper price discovery is to sell many times the annual production of gold and silver into the market very suddenly. And what that does, by selling it into the market with these unallocated contracts at a period where there was relatively low physical demand, is that they can take out the trading stops. All the major traders have stop losses or stops that are below the price. And so if you sell the price down or offer the price down enough, you will eventually hit these stop losses, which will cause the major traders to sell their positions to limit their losses. And by using that methodology, you can basically cascade the market down suddenly. And there's been lots of commentary about that for decades now, about how ridiculous the market sells off. And the reason is because it sells off in such a sudden, violent fashion, in a way that nobody that was trading for profit would possibly do. So, we saw, last year we saw with palladium what happens when there's physical shortage of the bars in the market. It prevents the use of these unallocated spot palladium contracts, for instance, from being used to cascade the market down. Because if you sell those contracts into the market, people will say, well, thank you for the promissory note. Now I would like to have delivery. And that forces the writer of that note into a default position when they can't deliver the metal because of shortage. So we're now seeing that, Ken, in the gold and silver market, where we've got more than a 90% decline in the spot trading volume, and that's the thing that I watch the most closely in London, and that is being driven because of the demand for the actual metal. And we've seen Deutsche Bank and Barclays and Scotia Mercado now are shutting down after 300 years. All these bullion banks are vacating the market because the old game of being able to control the market with paper and make guaranteed profits through the containment and the manipulation of the metals prices is gone. So
That's really pivotal and something that I think people need to really look out for. Now, I think it's interesting, David. Before COVID, before this crisis here, banks were the number two sector. The financial sector were the number two sector in the equity markets. Now, post, it's the fourth. The tech sector has taken over. So, is there any correlation beyond what is happening, with just people on Facebook more, on Netflix, on Amazon, doing these things that have grown the tech sector beyond the banking sector? But I mean, obviously what happened last year with the repo market and just all these things that are happening with bonds and just the problems in the credit markets. I mean, any commentary on that maybe ties into what we're seeing with the physical metals?
Well, yeah, it's all related that we have a debt bubble collapse, and as a consequence, we're going to have a fiat currency problem because it's a debt-based currency that we have, and so investors globally are fleeing into the things that you can't print, the secure things like gold and silver as a consequence. Like, just to give you a sense here, J.P. Morgan, they hold $2 trillion of bonds and loans on their balance sheet. Now they've just taken a roughly 10 or 11 billion dollar loss provision on their most recent quarter here. But you think about 10 or 11 billion provision versus a $2 trillion balance sheet. All of these banks are in serious trouble now because their assets are debt. And debt is precisely what cannot properly be repaid now because the debt bubble, the speculative bubble, has collapsed. So we're seeing this move now. I'm sure you've noted the change in the nature of the trading in the gold and silver market recently, and that is buyers showed up in volume at a time where the old price containment players have basically signaled that they do not have their price containment tool available to them anymore. The ability to sell many times annual production in a day into the market to crash the market. That tool is gone, and the tool is gone. We know that is gone because we can see that the trading volume has collapsed.
David, let's talk a little bit about what we're seeing right now. What do you think about these Robinhood traders now getting into gold in a big way and talking about the money that's starting to enter the sector? Now, I really thought millennials would have, eventually get into gold and silver, but I would have thought it was going to take inflation and many things to materially play out, headline news. But it's happening. I mean, I'm actually very surprised and pleasantly surprised at that we're starting to see this. But any commentary on this?
Yeah, I think that the day traders are probably affecting the market at the margins. I think the key here is actual physical metal shortage and serious investors getting into the market to take delivery. So for sure, you're going to see these, new arrivals show up and contribute to the demand in the market. And ultimately, it only takes once you're at a critical point, it only takes a small amount of additional demand to push you over the edge. But I think that the fact that people are becoming aware of the words gold and silver in terms of an investment is a good thing, because these are the secure and the safe assets in times of economic crisis, Ken. So there's lots of new people showing up, and you're reading about investors buying it, gold and silver, and taking delivery, who have never ever considered doing so before. So it all relates to the crash of the central bank debt bubble and the central bank debt economy, debt bubble economy. And when bubbles collapse, you need to hold lifeboats that give you security, and those are the things that the central banks, let's say, can no longer print, because for sure they were involved through the BIS and the major bullion banks in printing gold and silver. If you want to say that parenthetically, they were doing that for many years, and there's been a vacating of that market and of that tool because of the physical demand that we're seeing now, Ken.
Absolutely. And so you touched on this, but I want to bring it at you from another angle. When it comes to silver, first of all, do you believe silver will start to outperform gold here going forward? But I'd like to also add to that, with the economy shutting down, does the industrial component of silver at all make you hesitant to say silver is going to, explode here going forward? I know solar panel industry is working at 20%. And you have the situation where, this $2,400 a month, additional unemployment that, Americans are getting who are unemployed, PPP, $1,200 checks. The economy, as far as a consumer standpoint, is relatively robust because of all the stimulus. So, let's kind of touch on silver, break that down, and just what are your thoughts on the industrial component and it going forward?
Well, I mean, the total global mine production of silver every year is, in round numbers, of the order of about $30 billion. So, I mean, you have many, many trillions, tens of trillions of dollars of financial assets which have been destabilized now by the collapse of the debt bubble economy. So personally, I'm not overly concerned about the change in the nature of the buyers. Yeah, because of the absolute hordes who are going to show up as buyers because of the financial system destabilization. So yeah, no, I'm not concerned about that change, and because there's going to be a welter of demand now from people seeking safe haven, Ken. So, and what was the second question?
Well, yeah, it's very loaded, I guess. Do you believe silver to start outperforming gold here as capital starts to flow to the margins?
Well, it has outperformed gold this year so far.
Absolutely, it did. It absolutely
material fashion.
Right.
Yeah. So it's still nowhere near. It's less than half of the roughly $50 peak that we saw back in 2011. So whereas gold is at the all-time high. So silver is still well away from its all-time high price as well. So just from those two metrics, I'd say that there's a likelihood that it'll continue to be a strong performer. We'll see how it goes. But the thing too is that silver has historically been the day-to-day means of exchange, and that's why I think it has received so much attention, if you want to call it that, because you don't want a widely distributed substitute for fiat currency to be in the hands of the public. And it certainly would if the price was flying and Joe Public was aware of what a safe asset it was to hold when there's debt bubbles all around. So silver has been a terrible underperformer up until very recently, but I think that people, when they hold assets and want to use them over a period of disruption, silver was over centuries was the day-to-day medium of exchange for bread and milk and the things you buy on a daily basis, whereas gold was generally called the metal of kings and had a role for major savings over time. So I think silver is going to see a very strong comeback The question is it going to be able to be distributed widely enough in the public hands to make a difference? Because there's going to be a big push now for digital currency to lock everybody into a new monetary currency system. So we'll see. But certainly I think that silver has the capacity, just because of the terribly small above ground available stocks and the huge demand from the average investor. We call him Joe Sixpack, not in a pejorative sense, but the average guy on the street. That's the kind of thing that people can relate to if they can see it as an affordable asset. So, yeah, I think it has in short, I think, yes, silver has the ability to continue this strong performance that we've seen so far.
David, let's talk about the mining companies then. We saw gold companies, gold large majors really lead the way. And this outperformance with silver, I mean, literally just happened, right? And we really just started to see that move when silver was lagging and disappointing a lot of people. A lot of people were capitulating in silver because they were just so frustrated with its move in relation to gold and obviously all that's happened since 2011. But let's talk a little bit about what we've seen with capital flow from the large caps, the GDX, the GDXJ, and then, even like the silver companies kind of are in their own category here, with silver still so far below its 2011 high. I mean, it's just another category.
Yeah, I mean, I think the stocks are going to do tremendously well. The key concern that I have personally, Ken, is that, and this is one of the reasons I'm running a private mining company, or several mining companies, is the fact that when you're holding stocks, you're ultimately holding these assets in the financial system unless you take delivery of the actual share certificate. And the issue that I see as being crucial here is that the leverage of debt in the banks means that we're going to have a banking crisis at some time in the future. And when you have suspension of banking or interruption of banking, like all the major brokerages and trading houses are reliant on their bank accounts to function as well. So when you have a banking crisis, you're going to have a financial market crisis as well. And ultimately, the people that are holding assets in the financial system, I mean, Eric Sprott mentioned this a few weeks ago, and I couldn't agree more with him, was that he was saying that if you're going to hold stocks, he said that it was important for you to, in particular, safe haven stocks like gold and silver miners, that it was an important issue for people to take delivery of the share certificates to protect themselves. And I think it's, to hold a mining stock, gold or silver miner, and to hold it in a brokerage is, I'd equate that to, having a lifeboat inside the Titanic. And the goal ultimately for a safe haven is you want something that floats free of the financial system as it has its sinking prospects going forward.
I like that. I like that a lot, actually. David Jensen, everyone. David, if people want to learn more about you, obviously the brilliant work that you do, seriously, just an incredible pulse on what is going on in the markets. Let them know where they can go and what they can expect to find. Obviously, brilliant analysis on, kind of keeping up with what's going on with this shift that we are seeing in the markets, which I think is super pivotal. Probably one of the most insightful interviews I've done in a very long time.
Well, thank you. Real David Jensen on Twitter. I post, as saliently as I can, the things that I'm seeing happen in the market. But I would just, the story here is physical metal. We've seen what happens to a metal like palladium when shortage starts to show its head in the market. It absolutely cripples the paper sellers. The digital sellers down of the price are forced to vacate. And I think that we're now here on the very edge here of a new gold and silver market because of the overwhelming physical demand that we're seeing globally in the gold and silver market show up. And so all the bullion banks, they risk default if try their old games, and they well know that, which is why very systematically now they have vacated this market over the last 6 7 years. And there's the signal to me is so intense to look at those trading volumes. And by the way, if people go into the LBMA market and look at the net settled daily trading volumes, they should not be misled by those volumes, because there hasn't been much change in the net settled, which is balanced books at the end of the day. If you buy 10 contracts and you sell 9, then they say that you've only really had one transaction of one contract, 10 contracts minus 9 contracts. But the true story is in the true trading volume. And that's where you will see that. And historically, you can do that by looking at the local London liquidity survey of 2011, which gave us a 10-to-1 ratio of the net settled at the end of the day at that time versus the the total daily turnover or total daily trading volume. So you multiply those old numbers by 10. That number has drastically changed, and we saw that in the numbers that the LBMA started to release in 2018 of their daily trading volume, and we can see that it's dropped now to less than 10% of that volume. So a bit of a run on there, but yeah, real David Jensen on Twitter, and I focus on the physical market and what is going on there, and it's been a very, very change, Ken.
Appreciate you, David. Thank you so much for coming on the show with me once again. I look forward to doing this with you hopefully in another month or two, to get a real update on just the things that are changing. Things are changing so fast. So, I mean, we could be seeing a much higher gold and silver price, I think, in very short order here. So we'll need to stay on top of it. So again, thank you so much for your time.
Okay, Ken, that was my pleasure.